Just tell me when to start, Greta. When we have most people in, we'll wait a few seconds. People are still coming in. Welcome, everybody. We're going to wait a few more moments till everybody gets into the Zoom room. But thank you for spending your Friday afternoon with us. The numbers keep climbing in a good way.
I see Sherry's here today too. So Donna, hi Sherry.
Okay, Greta, I think we can kick it off, and we'll just people will be joining as we just go through the introduction. So again, everybody, good afternoon and welcome to our series that we're running, private equity and iBanking questions that you always wanted to ask. And today we're very fortunate to have another one of our friends from Bank of America to come in and talk about growth equity. Next slide, please. So this is Gregg Nahban, and Gregg's bio is right here. And I'm going to let Gregg introduce himself when we turn it over to Gregg. But just for your information, you have this, and you can see a whole bunch about him and what he's done in the growth equity space. And today is our opportunity to learn a little bit more about growth equity and ask any questions that you may have. Next slide, please. The way we're going to run this is the way we've run the other ones in the past. If you're having any technical problems or issues, please just email Greta, who works with me at the private equity program, and I will be monitoring the chat. So we ask you to come in muted, all right, because we hear a little bit of background noise. If we can have it come in muted, and if you have any questions and you can put them in the chat as we go along, that would be great. Next slide. Okay, that's me. I am the director of the private equity program and a faculty member at Columbia Business School. And there's a bigger, more fulsome bio of Gregg. You can see that Gregg has a strong connection to Columbia. He was an undergrad here at Columbia University. Please take a look at the private equity program. I know that we're coming toward the end of the semester, but we will be offering other things in the winter break and actually throughout the spring semester. And the best way to keep up with us is to check our website, which is listed right here for the private equity program, where we list all of our events. Okay. And Sherry is on the line. Sherry Zhu is on the line. Sherry was very kind to work with me early on and arrange this program with Bank of America, for which we are very grateful. There's a lot of planning that went into this, and it's gone very well. This is the last of our programs this fall, but we certainly hope it's not the last time that we interact with Bank of America in a way like this. The program has been very successful. We'd love to hear all of your feedback afterwards, and please take a photo if you don't have it, or if you don't have a pen and paper with you, of Sherry's email right there, because Sherry should be contacted with any questions that you may have after the program. Okay, so we're going to turn it over now to Gregg, who's going to give us a little bit a deeper dive into his bio, as well as a little bit of an insight into the area of growth equity. Now, remember, there's no question here that's too basic. That's why this program is put together. And so we're going to ask you to, if you don't, to type all your questions in the chat. I may unmute you and ask you to ask your question directly, or I may ask you a question for you in the interest of time, because I'll be seeing all the questions and I can put some of them together so we can make sure we get to as many people as possible. Okay, we're going to turn it over to you, Gregg. Thanks for coming.
Great. Thank you, Donna. And thank you, Greta. Good afternoon, everybody. And Sherry, thank you as well for helping put this together. I should say that, you know, I am a Columbia undergrad, and you should all be aware, you know, how thrilled I am to be able to share some observations with you over the course of the next, call it half hour or so. And I will also tell you that, you know, I'm a person that believes that Columbia really did change the trajectory of my life. I grew up in a small town in Massachusetts. I somehow landed at Columbia. I went from Columbia right to Wall Street when I was a very young man. And, it's been an extraordinary time. I'm in my 36th year on Wall Street. I'm an equity capital market banker. I've spent the entire 36 years in equity capital markets. Basically, it means that I'm an IPO banker, taking companies public, running follow-on transactions, block trades, convertible bond deals, et cetera, for companies in the United States and around the world. I've been with Bank of America for the last 14 years. I spent the majority of my career at Morgan Stanley prior to joining Bank of America. So that was a great experience. B of A has been exceptional, at least for me, certainly in terms of the breadth of the platform, the culture. And I major really in two sectors, although I'm a global vice chairman at the firm. So I spent a lot of time in China. This is obviously pre-pandemic. I spent a lot of time in Brazil. I've probably been to Brazil 75 or 80 times in my career. I've probably been to China, 30 to 35 times in my career, taken a lot of companies public in Brazil, taken a lot of companies public out of China. But I really major in two sectors, the consumer space, as well as the healthcare space. Those are the two businesses that I run globally for the bank. And I'd say over the last 18 or 19 years, I guess I've led something on the order of over 300 equity transactions, has raised $350 billion for companies around the world, and primarily in IPOs, but also follow-ons, blocks, et cetera. Next page, please. Okay, so just so you know what we're up against. This is a page basically just illustrating our competitive position. We compete against the best in the world at what they do best. You can see where we are in our healthcare business. Very, very competitive. $44.5 billion we've raised this year for clients. Well over 100 transactions, 10% market share. And in the consumer space, we have a dominant position in consumer, 20-ish% market share. You can see the number of transactions, et cetera, relative to Goldman, JP Morgan, and Morgan Stanley. So we've had a very good run in consumer year to date. I would say to you that the sort of the cool thing about working in both the consumer space and healthcare is, in the post-COVID world, health has become the new wealth, and so there's a heightened, extraordinary amount of focus on health and wellness. Obviously, we spend a lot of time underwriting life science companies, but also all sorts of healthcare companies. I'm in the market today pricing a transaction out of Brazil for Hitscherich, which is the largest hospital chain in Brazil. This company will have a $20 billion market cap, and we're running about a $2 billion IPO for them, pricing next Tuesday. And in the consumer space, we really try to blend, kind of traditional consumer with e-commerce, consumer technology. And again, we've had a very good run in that space this year, but I'm under no illusions. Our competition is stiff. We've got to earn it every day. No one gives it to us. And, we are in a very, very competitive business, but this is a business that we chose. Next page, please. So what's going on? Well, a lot's happened in the world in the last 9 months, 8 or 9 months, as all of you know. So we basically, we had a very significant downturn in markets. Actually, this was back in February, the fastest and most severe decline in the S&P 500 in history. And that was on the back of COVID, obviously. And then, of course, what happened subsequent to that, we had the greatest, the fastest bear market of all time, then the greatest policy panic of all time, and then the greatest Wall Street rally of all time. And you can see on page 2, the S&P up 63%, NASDAQ up 70%, 78% off its lows. S&P is up about 13% for the year, NASDAQ up 36% for the year. Issuance has been wildly broad across the platform, $470 billion of equity issuance year to date on Wall Street. What does that mean? That compares to that compares to the previous all-time record of in 20 years ago in 2000. Wall Street's been around for 220 years. We broke the record this year. The record we broke was the record set in the year 2000, 20 years ago, and we're 40% ahead of the all-time record. That's an equity issuance here in the United States. Again, about 470 billion of that. There's been 320 IPOs. about 125 billion or 130 billion of IPO issuance, and the average IPO is up about 58% on an offer to current basis. So it's been extraordinary. What I would say to you, if you move to the next page, we'll talk about some of the really interesting, this is what we refer to as the K-shaped recovery, or the game within the game. Pandemics have had huge and monumental impacts on civilization and societies over the last 2,000 years. And this one won't be any different. And what we're seeing is clearly this extraordinary tech and tech-enabled sectors have been the clear winners in the post-COVID world. That includes, of course, life sciences. That includes, the stay-at-home fitness, stay-at-home cleaning, stay-at-home entertainment with Netflix. You can see the upper right-hand bar, the green. These companies are up on average 82% year to date. So that's extraordinary. And then the underperformers, that's basically, airlines and cruising, luxury, et cetera, are down 42%. And I would say to you that in my experience in the last 36 years, I've never seen such a bifurcated response to the market to this type of event. I've been through oil crises and wars, but we've never seen such a major delineation between the winners and the underperformers. And this is basically COVID having its impact. And I'm guessing, we don't know for sure, but I'm guessing this impact will be extremely long lasting. As an example, there's been something on the order of close to 700 unicorns. These are private companies with billion-dollar plus valuations created. The vast majority of them are in the US and China. There are 3 unicorns being created per day. These are all tech and tech-enabled businesses, and these are really changing the landscape of American and global business. Next page, please. So if you think about growth equity over the last several years, you can see how the emphasis has been on significant crossover investors. These are people like BlackRock and Fidelity and Wellington and T. Rowe Price, who are traditional mutual fund investors, but are basically crossing over and now investing early stage growth equity. That basically moves as we move through the curve. You can see the companies that have emerged out of this, including Spotify and Uber. And as you head into this area of 2018, 19, and 20, you can see how it has become such a much more global phenomenon. Temasek, SoftBank, et cetera, investing, looking to put money to work in some of these extraordinary business. What I would say to you is that, as I mentioned, there's been a unicorn invented every 3 days in 2020. There are also 1,100 emerging unicorns. We call them icebergs. These are companies, private companies with a $250 to $1 billion equity value globally in the United States. 44% of all the unicorns are in the United States. 41% are in APAC, primarily China. So this is how you have to think about it. 44% of them in the United States. 41% are in APAC. The majority of the APAC ones, of course, are in China, and only 13% in Europe. This tells you where the growth is going to be over the next 5 to 10 years. 75% of the unicorns, by the way, are located in both California and New York. So for that matter, you're certainly in the right state from a school standpoint today. Next page, please. So, how do we think about private capital raise, minority stakes, IPOs, and SPACs? The way to think about this is that, companies that are growing rapidly need capital, right? They need capital to hire employees. They need capital to invest in businesses and plant. They need capital for research and development, as all of you know, as you're learning through your academic work. This capital is designed to drive monetization, capitalizing the companies with strong performance. In the end of the day, these companies have to get to a positive free cash flow one way or another. These upfront proceeds allow them to do that. There are considerations, meaning negatives. Finding the right partner is not always easy. It may limit other strategic alternatives. There's obviously governance considerations. There's typically two ways to take a company public. There's actually three. There's the traditional IPO, there's the SPAC, and there's the direct listing. At Bank of America, we're in all three businesses. A typical IPO is a book building and price discovery exercise. A SPAC is basically raising capital and effectively a blind pool, and then looking to buy a publicly traded company. And basically, it's a backdoor way for these companies to go public. It's an interesting strategy, especially for those companies that are not yet ready for a traditional IPO. And then there's, of course, a direct listing that some companies are doing, not often, but some companies are doing, where they're just listing their stock on the exchange, either NASDAQ or the New York Stock Exchange, typically with no primary capital being raised. Next page, please.
Yeah, Greg, just we could just stop here for one quick sec. So, it seems like SPACs are all the rage. And in fact, if you look at the data, they constitute a huge proportion of the IPO market this year. Do you want to just comment a little bit on SPACs, and have we seen SPACs before? I mean, maybe we've seen blank check preferred. How are SPACs different than the old blank check preferred companies that you and I might remember?
Yes. So, you're absolutely right, Donna. It is SPACs represent 40% of the IPO market year to date. So you're absolutely right using the word huge. It's a gigantic percentage. What I would say is that I'm a little cautious on, my own experience over the last 3.5 decades is that when Wall Street is running hard in one direction, my experience has been go in the other. And so I would put up a little bit of a Miranda warning on some of the SPAC activity. I think there's a whiff of speculation in it. It may be more than a whiff. Why is that? Well, a lot of funny things happen in a zero interest rate environment, if you think about it, right? So, if people have a choice to invest in bonds or equity, real estate, et cetera. We all know what's going on in real estate, commercial real estate, especially around COVID. Although home prices are rocketing in suburbs around the country, of course, as people exit cities. But with yields in the bond market at historic lows, there is a increased amount of pressure for equity in equity investing. SPACs are a really interesting alternative, but I would say to you that in my mind, it's been a little bit overdone this year. I do think that you've got to be a little cautious on the outlook for SPACs. Anytime you have a group of people that are raising capital, think about it, you raise the capital, you're absolutely right, it's blind pool. So SPACs have been around for the last 20 years, but they really have showcased themselves in the zero rate environment. But these companies are compelled to buy something. And anytime, as you know, Donna, in an M&A context, when you're compelled to buy something, you oftentimes have management teams and sponsors, et cetera, that make mistakes. And we won't know, as Warren Buffett says, you don't know who's swimming naked until the tide goes out. But the tide will go out. It goes out every single time. And when it goes out, there's going to be a lot of people that get exposed. So I am personally a little more cautious on the SPAC outlook than some. Maybe it's because I'm a little older and I've seen some of the downside when things get carried away, but it strikes me as the SPAC environment is so aggressive and so robust. My own view is that it's a little bit overdone. But I do think SPACs will be around for the long term. No question about it.
Yeah, I think people are taking solace in the fact that there are different governance provisions in these SPACs as opposed to what we remember as the blank check preferred companies. Meaning that before you deploy the capital, you need a shareholder vote. If you haven't deployed the capital in which so much time, the money gets redeployed. But I agree with you. I'll go out more on a limb than you will, since I don't have clients. I think it's way out on a limb. But if we could, before we move on, we have two great questions here. We have a question regarding Regeneron. So if Regeneron is a public company, I think on your prior slide, Greta, I don't know if you can move back one page. How can growth equity help a public company grow? That would be our first question. Then we have another one after that. That's good, right there, I think, Greta.
Yeah. So you're right. Regeneron's a public company. I mean, so are you ready for this, Donna? I actually worked on the Regeneron IPO in 1991. I was a young man. That's how many years ago that was. Almost 30 years ago. I worked on that IPO in 1991. Regeneron's an extraordinary company. We actually sold on behalf of Santa Fe, the big French pharmaceutical company, $12 billion of Regeneron back over Memorial Day weekend of this year. I do want to spend a moment on this because this I think will interest your students. Equity capital market capital formation on Wall Street has changed dramatically with COVID. So for example, we no longer take companies on the road. We do we raise $12 billion, right? We sold $12 billion of Regeneron on behalf of Sanofi over Memorial Day weekend, all over Zoom. The management team never left their house. Investors never left their house. The bankers never left their house. Everything was done over Zoom. And so we wall cross investors. I can explain what that is. Fidelity takes a meeting at 10 a.m. on Saturday. Wellington takes a meeting at 1 p.m. on Sunday, et cetera. And we launched the deal on Tuesday morning after Memorial Day, and we had $12 billion worth of sold by Tuesday night, $12 billion worth of Regeneron stock sold by Tuesday night. So that's point one. Point two is to answer your question specifically. There are publicly traded companies that do need access to private capital from time to time. Usually when that happens, though, it's under duress. It's basically the companies are not able to access capital from the standpoint of the traditional metrics, i.e. IPOs, follow-on offerings, or they don't have access to credit, et cetera. And so those companies are under duress. The vast majority of the highest quality companies that are taking private capital are going to be private. They are then basically then setting the terms on valuation. They're setting the terms, to your point, Donna, on deal structure, preferred, common, et cetera, convertible preferred, what are the terms, what's the coupons, et cetera, what are the premiums. And so typically when a public company accesses private capital, that company's under duress. So they would be on the K recovery, they'd be the lower bar.
Okay, and then on the second point, the question is, relation to the K-shaped recovery, you're seeing full industries or regions follow this K-shape, or is the recovery shape more accompanied by a company? So is this a regional thing? And then I'd like to follow up on this student's question. Hamilton asked this question by saying that Zoom roadshow that you did, do you think that there's a permanent place for that, even post-pandemic, or how do you feel about that? So really two kinds of questions there, two questions.
Two great questions. So I definitely think, to answer the question, the latter question first, I definitely think Zoom and WebEx and Microsoft Teams are with us permanently. I do not think that do I think that we'll do one-on-ones in New York and Boston? 50% of all the public money that's raised, that's managed in public equity, meaning, buying publicly or to be publicly traded companies are managed in two towns. That's the same as it was 35 years ago, New York and Boston. Do I think we may do one-on-ones in those two towns? Yes. But do I think I'm going to send a management team to Kansas City or Minneapolis for a one-on-one meeting to pick up a $25 million order? I don't believe that I'll do that. So I think Zoom and the way the markets are working today is exactly how it's going to remain. So I think the changes are absolutely permanent. It's all being digitized. And then number two, which is a really interesting question, it's definitely not regional. And so there are regions of the country that have been, actually now it's almost every region of the country obviously has been hit with COVID. What I would say to you is that there's extraordinary companies in very hard hit areas, and there are somewhat poorly traded companies sorry, my phone is ringing off the hook. There are poorly traded, there are less attractive companies in sort of more downtrodden parts of the country. So it is not a regional thing. It's very company specific.
Okay, thanks. That covers that. We can.
Okay.
Those are great questions. Keep the questions coming in the chat, folks. Great questions.
So this is on page 6, an illustration of investor universe. And so, these are all people that we do businesses with, that we sell equity to. As I mentioned, the early crossover people, the BlackRocks of the world, Bailey Giffords, Fidelities, Tigers, T. Rowe, Viking Capital. We spent a lot of time with sovereign wealth funds in the Middle East and in Asia. I worked on the Aramco IPO about a year ago. Which was still actually the largest IPO of all time. This is the privatization of Saudi Arabia's oil company. This is GIC, Temasek. These people are super interesting. Matter of fact, I was just on the phone with Temasek yesterday, and they were basically pitching me on taking positions in IPOs prior to the actual pricing of the transaction. Basically saying we want to be in early, we want to be guaranteed an allocation. We're comfortable with using our name on the cover of the prospectus. We also sell and raise money on a private basis with pension funds, OMERS out of Canada, Casa de Poe out of Canada, et cetera. So, these are incredibly important clients of ours. And then obviously family offices and more traditional growth equity. This is growth equity on the right-hand side. This is kind of the Advents and Cattertons of the world, people that we do a lot of business with. These are people, the way to think about growth equity, this is effectively private equity without leverage. And so the way to think about growth equity, it's private equity with a minimal amount of leverage. So that's TSG, L Catterton, Brentwood, Advent, et cetera. Most traditional LBO players, KKR, Blackstone, Carlyle, they have a much more levered type of approach to their investing style. And what I would say to you is that, of course, they're extraordinarily good at it, and their returns have been extraordinary. But I will also say to you that the growth equity, the lower leverage guys have also demonstrated better returns. They're also buying smaller companies. So they can buy smaller companies that are growing materially faster with a lot less leverage. Next page, please. Okay. Time for more questions, it looks like.
Okay, yeah. So we have our opportunity to do questions here. Anything you want about private equity, about IPOs, about the future of the industry, about what Gregg's seeing right now. I thought that was a really interesting point, Gregg, as many of these points have been, particularly on this Zoom. I mean, that's a big cost. So for those of you that might be new and that's why we're doing this, to reach out to people who are not necessarily experienced in investment banking. For those of you that might be new to the capital raising game, when an investment bank takes a company out on the road, right, we have what we call a road show where we engage in a process called building the book. That means going in front of groups of institutional investors, or as Gregg mentioned, having one-on-ones with individual institutional investors in an attempt to assess the interest in the security. That's a big cost. You have to fly around depending upon what company you're dealing with. You're obviously in New York for a lot of the institutional investors, but you may be flying to the West Coast. You may be flying actually to the Midwest if it's a healthcare company, and certain healthcare companies. You have to go where the institutional investors are, and that's a big time sink and a big cost. A lot of times people fly around in their own individual jets. Doing this, they might rent a plane, or as opposed to going commercial, just because you have so many places to go to in a particular period of time. We have another question here. How does COVID change the trends of growth PE investments on healthcare pharma in the long run, do you believe? I know you started your presentation out by saying that health is the new wealth, Gregg, but if you want to just elaborate a little bit on that.
Yeah, so I actually think this decade, we will look back on this 10, 20, 30 years from now as the decade of healthcare. And COVID is the driver of that. So that's point one. Point two is I sort of think of it as, in 2007, when Steve Jobs created the iPhone, Google bought Android, Twitter was spun, and the tens became sort of the decade of tech, right? This decade, I believe, will be the decade of healthcare. That's going to be driven by life science. When the young people in your class, I read this recently, in a few years they get married, they have children, this, that. There's a like a 60 or 70% chance that a child being born today will live to over 100. And that's science, right? That's technology. And so, there's going to be extraordinary things that are being done and will continue to be done in the life science and healthcare space. And so I think that this decade coming up, the decade of the 20s, remember, pandemics have had huge impacts on civilization and societies over the last 2,000 years. one of the big impact, I don't want to assume that, one of the smaller impacts, of course, is that we use Zoom to do IPOs. One of the big impact will be the influence of healthcare and life sciences on our world and how it changes societies and, you know, length of lives, quality of life, etc. So I think that's one of the most exciting areas to be in.
Okay. Okay. That's interesting. That's interesting. So you think it outpaces tech? You think tech gets taken over by health?
I don't know if it's a big statement, Donna. I don't want to I want to be careful. You're a professor. I want to, because you'll remember that one, I'm sure. I would say that I think it's going to be equivalent to tech. That's what I would say. I think the data, I mean, think about it. Data is being produced in parts of the West today at a 50% higher rate than it was in January of 2020. Think about that. Data is being produced. So it's like there is a massive technology explosion happening in a positive way, right? Not implosion, explosion. And so tech is, I mean, these unicorns are just incredible in terms of their ability to create value and change the world. So I think tech will be huge, but I think healthcare will be equivalent. That's how strong this is. I think people are underestimating it.
Okay, so let's just stick on that a minute. Then we have some really great questions from the students. So to the extent that we have a new administration and government seeks to be even more involved in healthcare rather than less, I don't know. I'm not expressing a view on whether that's a good thing or a bad thing, or whether it's necessary or not necessary. But I think we can all agree we're not sure what it looks like, but the predilection of the new will likely be the new administration is that there's going to be more regulation and more involvement. Okay. It rose from Andrew Cuomo saying that we're going to redouble check what the FDA does on the vaccine and distribution to everything else. Right. So how is that going to play? Right. Because it's interesting. You have this explosion in what would seem like a huge opportunity, but yet you seem to be thinking or facing more governmental regulation. So I'm wondering about that.
It's a great, and I'll give you an example of it. So, Pfizer is one of the authors, of course, of the vaccine that is going highly likely, I should say, to be hopefully, addressing and ultimately fixing this pandemic. But the UK is the first one to use it. They beat the US. They beat us. They're using it faster. And because they basically said, we want to get out ahead of the United States. And they did it. And that is in part, in my mind, because of some of the slowness that has occurred with, the government basically spent maybe, I want to be careful not to criticize, but the reality is that when you wake up every day, and especially on Wall Street, it is competitive. It's wildly competitive. And the vaccine was super competitive. How it was produced was competitive. Who won is competitive, and how it's distributed is competitive. So countries are going to compete against each other. Right. I've been to China, as I said, 35-ish times in my career. I've taken a bunch of companies public in China over the last few decades. There is no country that is more competitive from a capitalist standpoint than China. They're not a democracy, but they are capitalists, right? They're uber capitalists, hyper capitalists. And so, in the United States, if we're going to beat these guys, if we're going to beat them, we've got to up our game. So you're absolutely correct. And that means, and I mean that in a positive way. And I think government has to be both a partner and a regulator in the process, because I do believe in both, but a partner and a regulator. Because we are competing against countries around the world every single day. And the countries want to beat us. I mean, I'll give you an example. I mean, do you think that in Europe, the tech sector in the United States has a market cap ahead of all of Western Europe? Think about that. Do you think that makes Europeans happy? No, they don't like it. And so they're going to try to, but they've not been successful. Let's review. Name me 5 great European technology companies. Go ahead, I dare you. You can't do it. You can't do it.
No, no. I'm probably not the best. Well, let me admit, I'm probably not the best person to do it, but no, I can't do it.
Right, and so, but neither can I. And if they existed, I would know it. Right, I would know it, and so I can't do it. And the reason we can't do it is they don't exist. That's a problem.
No, but I think this is, I want to get to some of these questions, but I think this is a very interesting question, right? Because we're now seeing, so for example, I'm trying to remember where I heard it, but applications to medical school are up 30% as a result of COVID.
I hadn't heard of that.
Yes,
Interesting.
yes, I do. And my brother's a doc, and I'm a first responder myself, and I think that it's going to be very interesting to see what ends up happening, because I find as government gets more and more involved, it can go one of two ways, and I'm not sure which way it's going to go, because I think a lot of the innovation that we see, I don't know. It's interesting. I don't know. I don't know enough to speak about it, but I just wonder if we end up putting more regulation on things, if we're still going to be able to have the robust, pockets of competition that we've seen. I don't know the answer to that.
It's a great point, and you've taught me something today. I didn't realize that applications of medical, it makes perfect sense,
Right.
right? People want to help people,
Right.
I mean, we all want, right? I mean, is that one of the great lessons of COVID is we got to help out. We have to help people. I mean, you're a professor, you're a banker, you're in business school. Your trajectory of your life is different than the vast majority of Americans. It
Right.
just is. And so it is incumbent upon us that we gotta pull people up. We have to.
No, it's going to be a very interesting thing. So let's get to some of these questions, which are fabulous here. So for private equity growth investors, power plant ventures, et cetera, is there a lower need for financial technical skills? And is the skill set more skewed toward sourcing and negotiation?
Wow, that's a brilliant question. The answer is you've got to have technical skills. If you work in private equity, venture capital, investment banking, you must have great corporate finance skills. As I describe it as, you want to be an ECM banker, you need great corporate finance skills. This is what I do, ECM, equity capital markets. You need great corporate finance skills. You need great capital market skills and judgment, lots of deals, thousands of deals, right, over decades. And then you need to be able to walk into a boardroom and control that boardroom, control it. And I would say to you that that's the hardest part to learn. That's the hardest part. We teach everyone corporate finance skills. If you work at Bank of America for 5 years, we're going to teach you all those corporate finance skills. You work at Bank of America for a decade or more, or you're going to learn all the capital market skills. I would say the boardroom swagger, the boardroom influence, the boardroom ability to move the boardroom in your direction, that's the one skill that is the hardest to learn. But to answer the question specifically, no. In growth private equity, you must have great corporate finance skills. And you can learn them at Columbia and at business school, but you'll also, of course, learn them on the job.
Yeah, and I think we've talked about this a whole bunch. I mean, there's a quantum of credibility that you have to go in to be able to do the modeling and to do to get a seat at the table. But that's not the game. And it's interesting. Somebody recommended a book to me, and I haven't read it. I don't know if you have, Greg. It's called "What Got You Here Won't Get You There." What got you here won't get you there. I don't know if you've ever read it, and I haven't, so I'm not per se recommending it, but somebody recommended it to me. What got you here won't get you there. And that's, to a certain extent, that's one of the great things about a career in investment banking or private equity, is that you do need a certain skill set to get to the table, but that will not take you to where Gregg is, because Gregg has that ability to control the boardroom, to sit there with the CEO and say, listen, the book wasn't that strong, but I think we should go forward, or the book wasn't that strong and I think we should pull it and wait for a better time, right? And have the credibility to say something like that. And a truth is time takes time, right? And that comes.
Time takes time, and it doesn't exactly.
Yeah.
No one expects a young person coming out of Columbia Business School to be a modeling wizard.
Right.
That's not what we're looking for. We'd like you to have the aptitude to be able to do it.
Right.
But we don't expect you to be a wizard at it. We'll teach you that stuff.
And there are a lot of people that can do that, but you do have to have the ability and the curiosity to be able to do that.
Well, I describe it. It's a great point, Don. I was talking to somebody yesterday, and she said, why? She's a super senior person at our bank, and she said, tell me why you've had the success that you've had. And I said, oh, well, that's easy. I said, my job is my hobby.
Right.
I mean, I have other hobbies, but one of my hobbies is actually my career. It's a hobby. Like I live, you fall in love with the process. And so when your job is your hobby, you kind of don't have to go to work every day.
It's
a
funny you,
gift.
it's funny you said that. I was getting ready this morning and I was thinking about something. I was thinking about actually some of my Berkeley Embas that I have to reach out to. It was a technology thought that I had. And I said, I'm pretty fortunate. But my job has always been my passion. You know what I mean? And when I was on Wall Street, when I was a lawyer and here teaching. So that's a really important point. You definitely need to think about that and
And if
try to
you
find
don't,
something.
right, and you'd agree
Yeah.
with this, Donna, if you don't love what you do, don't do it.
Yeah.
No
Life's
amount
too
of money,
short.
no amount of money is going to make you happy.
Right.
If you think money's going to make you happy, go see a doctor. Like
Right.
that's not the money. Like you got to love what you do, and then you have to become great at it. And becoming great at something takes, I'd say, 12 to 15 years. The whole 10,000 hour thing. And it may be longer, but it's much more important to love what you do than it is to make a lot of money, because the money will come. And it's not even about the money. It's about having a passion and love for what you do. Way more important.
Okay, Kayla has a great question here. Love to hear your thoughts on the outlook for consumer equity growth space, given that it's getting increasingly competitive as large players move down in check size and strategics get more active in M&A. Any thoughts on that?
Yes, that's another really good question. So, digitalization. It's like it is. I think it's gonna be. It used to be bricks and mortar, and that drove digital. Now it's digital that drives bricks and mortar. I'm not saying there won't be stores. Of course, there will be people like going, but in the end, it's the digitalization of the consumer space. And so I do think that growth equity in the consumer space. I don't think it. I know it. I mean, I have a notebook here with 15 or 17 IPOs that I mandated on in the consumer space that we're running over the next year or two. And these companies are extraordinarily. Some of them have brand names that you would know, and virtually all of them have a technology focus. We call them consumer technology companies. They're no longer consumer. It's actually consumer tech.
Right.
That is where we're headed.
Yeah, I had a speaker in my M&A class from Wells Fargo, growth equity, and he said, you have tech companies and then you have tech-enabled companies, and
Yes.
To the extent that you can make a company tech-enabled, that gives it even a better multiple, a better trajectory.
No question about it.
So pure tech companies on one hand, and then tech-enabled companies, and tech-enabled companies is a very broad category of companies. Okay, Amanda asks a wonderful question here. She said, first of all, she says, thanks for the webinar. And she said, it's been great. So thank you, Gregg. And a lot of people have said that too. Not just Amanda. Do you foresee growth valuations continuing to rise? And where do the levels of dry powder that we've seen, which is about 1.5 trillion now, become counterproductive? Or you don't think you're going to see all that stuff released? What do you think? Where are valuations headed? And, is all this dry powder now going to come crashing out? Or are we going to be building up a stockpile of it?
So I think so. I have a view that, and I may be wrong here, but my own personal view is that we're going to get a whiff of inflation over the next 6 to 12 months. When I came into the business, 36 years ago, people said interest rates are high, inflation is high, and they'll never go down. Well, they were dead wrong, right? Now everyone's saying interest rates are low and inflation is low and it'll never go up. But I spent a lot of time studying commodity prices. Like I'm uber focused on copper and steel and iron ore and oil, because to me commodity prices are the great harbinger of future economic growth. Copper's at a 7-year high. Iron ore is at a 9-year high. Oil is rallying. And so I'm thinking to myself, there's something going on in the world economy that most people are not anticipating. What is it? The global GDP, Bank of America's global GDP view for this year is up 5.4%. That's the highest global GDP since 1973. Okay, that's point one. Point two is our U.S. forecast for global GDP is 4.5%. That's the highest it's been for 2021. That's the highest it's been since 1999. So 5.4% globally, highest since 1973. 4.5% in the United States, highest since 1999. In China, we have growing at 8.5%, and that's the highest in about 11 years. And so, yeah, 8.5% highest since 2011, call it 9 years. And so what I would say to you is that I think the upside surprise is going to be on interest rates and inflation. The downside surprise in the near term, I don't mean secular, I mean cyclical, meaning near term over the next 1 to 2 years is going to be a contraction in equity value and high growth of the equity valuations. I think they're coming down. And I think they're coming down because inflation, growth is going higher. Inflation will probably pick up. The Fed is going to raise rates faster than people think. That will take some of the air out of the bubble on high growth tech and tech enabled valuations. And the market will then rotate to value. And value will be energy and financials. So that's my economic.
Whoa, I didn't think we had energy in this country anymore.
You'll be surprised. Energy stocks are, I mean, ExxonMobil's been around since 1885, I think it is. You'd be surprised. I think that energy stocks now they will transform themselves. There's going to be a major push in hydrogen, right? I mean, these companies are under enormous pressure, as they should be, to lower their carbon footprint. All companies are. I mean, companies are going to have a zero carbon footprint by 2040 or 50. That's where we're headed. But energy companies will be around, but they will be transformed.
Okay.
Yeah.
Okay. So building on that, this is a really great question that Walter asked, Mr. Love. And it says, some argue that the digital acceleration social media will diminish the value of a moat or a brand as staying power. What do you think about that? Do you think that that's true? Makes it easier for upstart brands to come in and that's really going to hurt some of the majors, or the majors are going to they just have such an incumbency that it doesn't matter?
Wow, that's a great question. So I am a huge believer in Warren Buffett's view of investing, which is focusing on strong balance sheets, great management teams, leaders, high return on invested capital, free cash flow, and competitive economic moat. So that's massive. Like that's how I invest personally. That's how I think about taking companies public. One of the questions I ask people is, what is the economic moat around this business? I do think that digitalization will impair weak economic moats, but I think digitalization will have a harder time with some of the economic moats that have been created and will be sustained. And those are obviously companies like Amazon, Google, Microsoft, and Apple.
Okay. We got another Regeneron follow-up. Why did you? What was the reason Regeneron brought back shares from Sanofi? Was they were lacking the funding, but they wanted back control. What's your thoughts on that?
Great question. So the answer was they thought the stock was cheap. Turned out they were right. They bought the stock about 50%, or actually about 30% lower than where it's trading today. So they wanted to. Obviously, there's two ways to return capital, right? One is through dividends, and one is through buybacks, and return capital to shareholders. And so they bought back Sanofi shares. They retire those shares, so there's less shares outstanding, of course, which helps over time earnings per share. So your denominator goes down. And the result is that they wanted to return capital to investors by buying back that stock and retiring those shares. Turned out that was a very smart move on behalf of Regeneron for its shareholders. Okay,
great. We have a question about secondary. So when private equity firms, right? So are you talking about Ohm? Let me ask you, Ohm, if you want to unmute yourself and clarify. Are you talking about secondary funds, PE secondary funds, or are you talking about one private equity firm selling to another private equity firm? You want to unmute yourself and clarify, or clarify in the chat? Oh, funds. Okay, good. Clarified in the chat. So are you seeing, what's your thought? So private equity secondary funds are when somebody, an LP, owns shares in a private equity fund, and the LP wants to have a monetization event, right? They want to get out of the fund. And so a secondary fund will buy the LP's shares in the particular fund. And so Ohm's question is, where do we see that going in light of the pandemic? Any change?
So I think private equity is going to be very crowded. I think it is crowded. I think it's going to be So I do think that there's going to be, the winners will be the biggest companies, and they're really more asset management businesses today than just pure private equity businesses. Blackstone, Carlyle, KKR, obviously. And then I also think the growth equity players like L. Catterton and others are going to be the winners. Do I think there'll be migration away from sort of your average private equity return people? Yes. So do I think there will be pressure, and therefore companies, or I should say private equity firms that don't survive or prosper over the next decade? I do. I think the returns are going to be more subdued, right? Because valuations are high, right? When by definition, valuations are high, so the returns have to come down. And the competition is so intense because of the amount of capital that's chasing. If you think about private equity, I mean, private equity has returned about 200 basis points ahead of the S&P 500 over the last, call it 30 or 35 or 40 years. So there is a premium, but the counterfactual to that is you give up liquidity, right? So you have no liquidity. So by definition, you hand over, you give up liquidity, you have to have enhanced return. The enhanced return is about 200 basis points ahead of the S&P 500, which has returned about 9% per year. It's actually 7.5 plus a 2% dividend yield over the last 150 years. It's about 11% for the top private equity guys, 200 basis points in advance of the S&P 500. That's the math.
Wow, that's great. This has been super helpful on a variety of fronts here. Let's see. Wei asks a question here. He wants to know the competitive. You mentioned, Greg, that you'd spend time in China, and so do you see the competitive market for capital raising and allocation changing? How do you see that changing over the next decade? We touched on that a little bit. And where do you see China playing a role?
Bigger, bolder, badder, not bad in a negative way. I just think that China is, people are, I mean, like the whole Ant thing, the Ant IPO, when Xi basically, they were on the 2-yard line about to go public, and Prime Minister Xi basically nuked the deal. I mean, that was that would never happen in the United States, but authoritarianism, that happens. I mean, that's the way that you give up something for that, right? So you give up. On the other hand, I think China is going to be a massive play for Wall Street, massive play for private equity. But I don't believe that for all of Asia. Like I'm like, people say to me, oh no, don't forget Malaysia, don't forget Thailand. I'm like, let's get China right. We get China right, APAC takes care of itself. We get China wrong, it doesn't really matter what we do in Singapore. And nothing wrong with Singapore or Malaysia or whatever. It's just China is just so big. And so, as I mentioned, almost 42% of all the unicorns are based in China. And so we have to get China right. I think China is going to be an incredibly important player. I think China is going to be a force, politically, politically, geopolitically for the United States. But I also think the two strongest countries in the world have got to. They're going to. Of course, we're going to compete against China, but we also have to. We also have to work with them and be friends, right? So you can be you can be competitive and be friends at the same time. And I think that's what's going to happen.
Okay, I'm going to ask a question of my own here. We're almost getting this. These have been fabulous questions, folks, and we only have five minutes left. So please type any additional questions you may have here. But I have a question for you. What's your biggest fear over the next 18 months for the markets and business? What's your biggest fear over the next 18 months?
Another pandemic. I think that Bill Gates, I read a lot about Bill Gates. I read a lot of this. I mean, if we just listen to Bill Gates, we'd avoid he's so smart, we'd avoid a lot of problems. As human population grows, we get closer to animals. As the environment, the wild environment shrinks, animals come into our midst. That creates pandemics. And so this vaccine won't work on the next pandemic. So what I would say to you is that I think the risk is that, think about, we got this vaccine where people are going to get the vaccine within days, right? Usually it takes 10 to 12 years. It took 9 months or 8 months or whatever, 9 months. I mean, it's extraordinary what's happened. So the next time will be even shorter. So I think government, there's got to be which I just like after 9/11. Think of 9/11, how the world, your students are too young, obviously, for this, but think about how 9/11 changed how you and I approach travel, how we checked into hotels, how we checked into buildings in Manhattan, IDs, this, that. We never had that, right? I mean, 25 years ago, I just ran onto the plane. I barely went through, they barely checked me. I mean, I think I went through some kind of a metal detector, but I don't really remember.
No, we all just ran on. I mean, we could run onto the plane with 15 minutes. I mean, it was like no big deal. You'd be running down the thing, and they'd be like, "All right, we'll hold the plane." Yeah,
we'll hold the plane, right? They don't.
Right.
So travel and 9/11 changed the world, or our world, and this pandemic is changing our world. So my concern is that there's another one, and it rattles the markets, but our response is going to be so much better this time, the next time. Because people are going to say, okay, so like, it's not, if you think about pandemics, what they did 1,000 years ago, you social distance, you put a mask on. It hasn't changed. The vaccine, of course, is the game changer. I mean, the Black Plague in 1300 wiped out 1/3 of the world's population. 1/3. 1/3 of the world's population was wiped out. I mean, the Spanish flu in 1918 wiped out almost 700,000 Americans, and the population of America at the time was 125 million people. And so, we're going to have others. I think there's going to be almost like a defense department now built in government to combat plagues. And I think that's what has to happen.
Interesting. Yeah, that's interesting. I wonder though, I guess my biggest fear is the credibility around government, because I do think, I mean, I am old enough to remember 9/11. I remember going to work and I said, gee, this is weird. There are no planes. Why are there no planes? I was living in Forest Hills at the time. And yeah, I think government lost a lot of credibility on that. And I think people do. That's what I worry about this whole thing. The credibility of government is that. Okay, good. Any other questions? I got to check my battery here on for some reason, my computer. Any other questions?
Okay.
All righty. Well, I want to thank you. Let me just get my battery going here. It's for some reason my Lenovo battery is going low. I don't know why. But I want to thank you for all of that. Greta, do we have any comments or anything that we need to say?
I just want to say thank you. I know we've had a lot of repeat customers the last 3 sessions. And it's been great to see so many of you here. And thank you all for your kind feedback. Thank you, Bank of America. Thank you, Sherry Zhu from Bank of America, who let us do this. No, other than that, we're glad to see all of you, and we're hoping to do more of these next year.
Yes, we are. We are. We don't view this as just a pandemic. Finally, I'm sorry, I had to plug my computer in. We don't view this as just a pandemic thing. I think it's really important to get to know, alumni and friends of Columbia Business School, and also to learn something in the process. And I tell you, I learned a lot, Greg, and I really appreciate it. And I think one of the things that's really important about bringing speakers in is we want everybody on the line to realize how excited everybody is about their job. You've got to find that. You've got to find a job, and you might not even know what that job is right now, but you've got to meet a lot of people and get out there a lot to find out exactly what you are passionate about. You might not even know what that is right now, but you might hear somebody like Greg or the other speakers that we had, that just excites something in you that you didn't think about. So please be open to that. And thank you all for coming today and spending your Friday with us. And a big thanks to Sherry, Bank of America, and most of all you, Greg. It was really, really, really exciting. And we really thank you. It was great.
Very welcome, Donna. You've been a great host. Thank you so much, Greta. And Sherry has my contact information. If I can help any of the kids, delighted to do that too.
Okay. All right, guys. Well, thanks so much. We'll talk soon. Bye-bye.
Thank you. Bye-bye.
It's funny. I didn't realize I was my battery. I noticed my screen got a little dark, and I'm like, why did that happen? My computer wasn't plugged in. I was like, ooh, that was bad. All right. Well, thanks everybody.
I'm gonna end the meeting now.
Okay.
So, I'll talk to you later.
Okay. Bye, everybody. Bye.